Video 8, Fractional Deposit. I'm Rick Nichols. I wrote a book titled Make America Financially Great. This book is based on 15 years of research that included the 1913 Federal Reserve Act and 1864 National Currency Act. A concept that was developed by the Bank of England Corporation that is taught to everybody is called Fractional Reserve Banking. That is the concept that a bank will deliver $100 worth of paper currency that promises to be redeemable for gold, but the bank only has $10 in gold reserved. I'm going to use the term gold to include silver and all other precious metals used as money, so I don't have to keep repeating the list. A run on the bank occurs if all $100 of paper currency is asked to be redeemed for gold, but the bank doesn't have enough gold. So the bank fails and everybody who is holding paper currency or had an account in the bank loses their money. After studying the 1694 Charter of the Corporation of the Bank of England and Alexander Hamilton's 1791 letter to Congress for the first Bank of the United States Corporation, I renamed the concept of fractional reserve banking to fractional deposit banking. I'm going to explain a great scam. I'm telling you this because it is very confusing to grasp because it is a scam and it doesn't make sense. The fact is that the financial bad guys are stealing from us, but they have a great story that sounds right. Actually, we have to give them credit for the greatest scam in the history of the world. The scam is based on the term borrow. The term borrow is used as a double-entendre, which means it has two meanings. The second meaning is normally risqué, but in this case, the second meaning is the scam. The first meaning is the customer borrows from the bank. The second meaning is the bank borrows from the bank. The scam is that the customer borrows from the bank while at the same time the bank borrows the same amount to loan to the customer. So the scam is that the bank borrows from itself something that the bank doesn't have and loans it to their country as the country's national debt. This is a real hard concept to grasp because it sounds like gobbledygook, but it works because this is one of the methods that increases the M2 and M3 money inventory counts and keeps the inventory going up and up. The banker makes a profit on every new piece of money they create. They use a system I call evidence of banker's debt. This is the system that created financial instruments. Financial instruments are the scam because they are used by the bank to borrow from the bank. A financial instrument substitutes for a deposit of gold on accounting books. It is a depositless deposit that is used to increase an account balance without depositing gold. The first evidence of banker's debt used as a depositless deposit was created in the 1694 Charter of the Corporation of the Bank of England. It said the Bank of England Corporation could be in debt to borrow, owe, or give security by bill, bond, or other covenant or agreement. The meaning is that the Bank of England could use a bill, bond, or covenant or agreement as a borrowing device. That borrowing device is accounted for as an asset. A bill as a borrowing device is paper currency. The bank is in debt for the amount of paper currency it delivers to customers. It is a debt for the amount of gold that the bill promises to redeem. A bond is also a borrowing device. It is essentially a loan agreement, but in the case of central banks, the bond is the same as a United States Treasury bond. It borrows a country's national debt. The Bank of England Corporation is in debt for the amount of English Treasury bonds it buys with an account balance increase in the King and Queen's account at the Bank of England Corporation. The problem is it doesn't have enough gold to pay for the bond in real money, which was gold, but it can use a depositless deposit to increase the King and Queen's account balance. A covenant or agreement as a borrowing device is a loan agreement. The Bank of England Corporation is in debt for the amount of loan agreements it uses to increase the borrower's bank account balance. The Bank of England Corporation was authorized to be in debt by using bills, bonds, and loan agreements as evidence of bankers' debt for a total of $1.2 million. The bills, bonds, and loan agreements are known today as financial instruments, which have also been authorized to function as fiat money. Here is a quick example about bank accounting in the old days when gold was money. When a customer deposited a gold coin, the customer received a credit to their bank account and their balance went up. The customer filled out a deposit slip and took it with $10 gold coin and deposited it in the bank. The gold was sent to the bank vault. The deposit slip was sent to the accounting department. The accounting department makes two accounting entries. The first is the gold is accounted for as an asset. The inventory of gold is increased by $10. Second, the customer's account balance is increased by $10. A customer's account balance is accounted for as a bank liability. The way to think about accounting is that assets is the inventory of gold in the bank's vault, and liabilities is the list of customers who may withdraw the assets. At this point, the bank is liable to one customer for $10, and there is $10 in gold in the bank's vault. The customer may withdraw his $10 in gold. The account's balance. Everything is okay. The problem starts when the bank makes a loan to another customer. Alexander Hamilton said the first thing the bank does is to require that the customer open a bank account. Then the customer borrower signs a loan agreement. In this example, the customer is the King and Queen of England, and their loan agreement is pre-printed on the bond, which is an English Treasury bond that is used to borrow the English national debt. Let's say the King and Queen borrows $100 with a bond. The bank then fills out a deposit slip and sends it to the accounting department. The bond goes to the vault. The accounting department accounts for the bond as an asset, just like a deposit of gold. The inventory of assets is increased by $100, so the total assets held by the bank is $100 in bonds and $10 in gold, which totals $110 worth of bank assets. The two customers are accounted for as liabilities. The total amount of customer account balances is $110. The bank says everything is okay because assets equals liability, and that means the account's balance, which is their measure of honesty. The part of banking that does work to replace gold as money is the account balance transfer. Customer 1 may transfer his $10 account balance to the King and Queen as tax payment, and the King and Queen could transfer $100 to the customer, who is a farmer, to buy food. The account-to-account balance transfer works great and is not the problem. The problem is that there is only $10 in gold, so both customers cannot withdraw their balance in gold. If both customers insist on withdrawing their balance in gold, then there will be a run on the bank. The banker's solution is to print bills, which is paper currency. The bank prints $100 in bills so the customers could withdraw their account balance in paper currency. The problem is that there is $100 in bills promising to be redeemed for gold, but the Bank of England Corporation only has $10 in gold. The point is that the gold is actual money. The bills, bonds, loan agreements, and account balances are only promises to redeem money. The Bank of England was supposed to borrow $100 in gold so it can redeem its paper currency, or borrow another $100 in gold so their customers could withdraw their account balance in gold. But the Bank of England Corporation doesn't borrow gold, and that is the scam. The Bank of England is in debt to the customers for $110. The Bank of England is also in debt for $100 in bills as paper currency. So the bank has promised to redeem $210 worth of gold, but it only took in $10 as a real deposit. This is one of the reasons why the government-sponsored corporations, as central banks, can buy all the treasury bonds a country used to borrow their national debt. All central bankers had to do is borrow something they didn't have from themselves, and they had a lot of that, and deposit what they don't have as an asset. That's why I call that a depositless deposit. The reality is, you can't withdraw gold that wasn't deposited because bills, bonds, and loan agreements were used as evidence of bankers' debt to replace the deposit of gold. The only deposit that is a deposit of gold. The gold is used as a reserve to redeem bills, bonds, and loan agreements that were accounted for as assets. That is why the concept of fractional reserve is actually based on fractional deposit of gold. That's the national debt scam. My book is Make America Financially Great. Thank you for listening to the research of a fellow American citizen.